Okay, today we're going to discuss how a simple loan works. The reason why we're going to do this is because oftentimes when you're starting a new business, and even if you're not starting a new business, even if it's an existing business, you will be using a loan to finance some of your operations. Okay, so what I'm going to do today is I'm going to walk you guys to understanding how a loan works from the figures perspective. We're going to go through the math. We're going to make sure that we understand what we're paying for every time and how it breaks down between how much we are paying of the original money that we borrowed and how much we are paying in interest. Now to do this, I'm going to explain a simple loan. Why? Because most of the loans that you're going to be using are going to be a simple loan. There are other more complex financial instruments that you can use, but I think we need to start walking before we can run. Okay. So what we're going to try to do today is I'm going to walk you through all the steps that you need to follow for you to be able to create your own amortization chart or table in Excel. I know that there are sources that you can use where you can borrow a template. I know that there are financial calculators online that can do some of this stuff for you. But in my opinion, for you to really understand how something works, the best way to do that is to do it yourself. And given that we have the tools right now to make a lot of these computations easy for you, especially using Excel, we're going to just use those tools and with a few formulas that you can input yourself, which is the whole point. And we're going to try to get the same results that you will get from one of those fancy financial calculators online and or from a template. Okay. So let's start by understanding what you pay for in a loan. A loan, I think everybody understands. What you do is you borrow from an entity, usually a bank, but it doesn't have to be, right? From a bank or from another financial institution, you borrow some money. Okay, that money that you borrow, we're going to call principal. Okay, so whenever I talk about the principal in a loan, what I'm talking about is the amount of money that you actually are borrowing from the financial institution. Okay. And what we're trying to do today is we're trying to figure out, given a given principal, like a given amount of money that you're borrowing from the bank, how much money are you going to be returning every month? Okay, every month. And we're going to call that amount of money that we return every month, we're going to call it the monthly payment. I'm assuming this is not surprising to anybody because I'm sure that at this point either you have some loan or you've seen maybe other people use loans. So I'm assuming that you're aware of that once that you borrow money, you need to return it, usually on a monthly basis. Professor, there are some loans that are yearly, bi-monthly. Yeah, there are different payment schedules. We're going to stick to the most common one here, which is monthly, okay, which is the one that I suspect most of you will have experience with for the most part. Okay, good. And what we're going to do is we're going to work out the math to figure out exactly what the monthly payment is, given essentially three things. Okay, three things. One is A, how much money you borrow, which is your principal, like I was saying before, right? So your principal is going to tell you how much money you're borrowing. Okay, that's going to be P. Okay. The second thing, it's going to be the number of months that you're going to be paying this over, right? Better said, the number of payments that you're going to be making, right, in a given year. That's going to be N here. Okay. And finally, we're going to have our interest rate. This is the amount of money that the bank charges you for lending you the money. Okay, we're going to call that R. Okay. Now, this formula right here is the one that we're going to use to compute your monthly payment. And I'm going to walk you through each of these steps, okay, just to make sure that you understand. As you can see, the formula has three terms on it that are different, right? You have P, which we already said what it is the principal. So that's a fixed quantity that you enter in the beginning and then you're done, right? Second thing that you have is you have R. What is R? R, if you're paying in a monthly basis, which is what we're going to assume here, R is not going to be your yearly interest rate. It's going to be your monthly interest rate. And this is usually not the quantity that is discussed whenever you see a commercial about a loan. Like if you see a commercial on a mortgage or a car loan, which is what we're going to do for the exercise, by the way. You usually don't see monthly interest In fact, I can't remember of any time where this has been discussed in a commercial at all. It's usually a yearly interest rate that you will see. Okay. Now you need to be aware that in this formula, for you to get the correct results, which is what we want, you cannot enter yearly interest rate. You need to enter monthly interest rate. But, lucky for us, that is really easy to do. All I need to do to get my monthly interest rate is divide my yearly interest rate by 12. So if your yearly interest rate is 12%, you just divide it by 12 and you get a 1% monthly interest rate. I'm assuming that is not very difficult. And what you'll do is you'll plug in R, which is that 1% in this example that I'm giving you, into all the instances in the formula where it shows up. You can see that R in this formula shows up in 3 places, right here. Okay, sorry, right here. I'm having trouble with my computer, right here, and right here. Okay, good. And then finally, the last term that we have in that equation, other than ones, which I'm sure everybody knows what those are, right? It's N. What is N? N is the number of payments that we're going to make. And in a typical simple loan, the ones that you're going to find in the marketplace, you're going to make a payment every month. So if you're making a payment every month and the interest rate, it's going to be monthly. Rn in this case is going to take the number 12 if it's a 1-year loan, right? But most loans are not 1 year loans. So if you are having a loan that is, for example, over 10 years, N will be 10 years times 12 payments a year. That will be a total of 120 payments. So N is going to reflect over what period of time we're going to be returning this loan. Okay, and it's the total number of payments that we make. So again, it's going to be a function of the number of payments we make per year and the number of years of the loan. So for example, if you have 10 years, that will be 120 payments, so N will be 120. If you have 30 years, which is a typical mortgage, although there are others, probably the most typical mortgage, and 30 times 12 will be 360. So N in a mortgage that is over 30 years and you pay monthly, it's going to be 360. Okay, I'll show you with some examples how we're going to use these calculations. But the nice thing about this formula, even though it looks a little bit maybe imposing at first, is that once that you have those 3 quantities, right, once that you know P, you know R, and you know N, all you need to do is plug it in here and you will get a number. And the good thing, or the simple thing about simple loans, is that your monthly payment is the same every month and doesn't change. Okay, no matter whether it's the first month you're paying or the last month you're paying on your loan, you're always going to say paying the same quantity. However, that quantity that you're paying, it's not all the same in terms of where that money goes. What do I mean by this? Well, originally you borrow a large quantity of money, we call that the principal. And because of that, in the beginning, you own a lot of money, so you pay mostly interest. Okay, why? Because you own a lot. So most of the money that you're paying monthly, it's going to go towards the interest. On the other hand, at the end, when you're almost done, when you're on your last payment, you've almost returned all your principal. So you barely own any money at that point. So most of the money that you're paying, which is the same quantity, your monthly payment, like I said, doesn't change. It's going to go towards principal payment. Okay. So now what we're going to try to do is we're going to try to break down how this quantity is going to change over time in terms of what is it applied to. Is it going to be principal or is it going to be interest? So the principle behind this conversation is what I just alluded to, right? What you pay per month, and in financial terms, we call that debt service, right? Or monthly payment in everyday parlor, I guess. It's going to be a function of 2 things, and these things are going to change, although this quantity on the right side doesn't change. This is always the same. This is always a quantity that is fixed throughout the loan. But the 2 on the left side are going to be changing. You have principal, which is returning some of the money that you actually borrowed, and interest, which is the amount of money that the financial institution gets paid for lending you the money. Okay. So what we're going to see now is with, precise numbers how these quantities are going to be shifting over time. That's what essentially we're going to be computing in our amortization table. That way we can see exactly how much interest we pay in and exactly when we are returning the principal. Okay. Now let me show you with an example how this give and take is actually happening. Right? Notice in this diagram we have as a x-axis we have time, right? So as you can see, the number of months, this is a mortgage, and like I said before, typical mortgages, although there are others, typical mortgages are 30-year loans, right? So that means that you will pay 360 payments, right, or 360 months. You can see that reflected here in the chart, right? We start in the beginning, right, month 1, and we go all the way to 360, right? And what do we have here in the y payment? In the y-axis we have dollars. Okay. So what you can see here from the formula that I was showing you before is that the debt service payment, which is basically the monthly payment we call usually, that doesn't change at all over time. How can I see that? The line is flat, right? My payment is going to be the same in all cases, no matter what. Okay. No matter what. So I'm paying always the same amount, but that amount is going to different things. And if you remember, there are two things that it's going towards. The first thing that it's going towards is paying back the borrowed money. We call that principal. And the second thing that you're going to be paying for is interest. Now notice that I don't have here the principal, which will be essentially the opposite, the mirror opposite to this line here. But if you look at the interest payment, which I do have in the diagram here, it has a funny shape, right? Here. But what's interesting for you to notice is that in the beginning, because we haven't paid any of the money back, we owe a lot of money, so we pay a lot in interest. And over time, we start chipping away at that principal, and our interest starts dropping. And then suddenly on the last payment right here, because we barely own any money, we barely pay anything in interest, and all we do is we return principal. Okay, so you can see that that line in the end hits 0. Okay, so it's this trade-off that we're trying to understand to make sure that we know how much we're paying in each of these two things. Okay, interest and principal. Now, what I'm going to do is I'm going to work out with a specific example, just because I think it's easier to understand this being concrete. Okay, so I'm going to assume that you're borrowing $100,000. Okay, that your interest rate in a year it's going to be 8%. That this is a mortgage, and because of that, you're going to be paying that mortgage over 30 years. Okay, and that if you apply the formula that we have right here, that's going to yield a certain monthly payment, right? So let me show you what we're going to plug in into this equation that comes from the first line. Okay, the first thing that you need to put in the formula is P, right? Which is my principal. Now in this case, I am assuming that there is no down payment, and because of that, if the home cost $100,000, I am borrowing $100,000. Now in real life, you're probably going to be putting a down payment for example, a car. If that's the case, the price, I can't write with this thing. Price minus the down payment is going to be your principal. Okay, so if the home was $120,000 and I put down a $20,000 payment, then my principal will be $100,000. Okay, I want you to not forget this because this is important. So always your principal is the amount that you borrow from the bank, not the amount that you pay for the good or the service. Okay, if it's being financed. Okay, and yes, services can be financed as well. Good. So then we have the interest rate. Now remember, in most cases, most contracts, they will give you the interest rate in a yearly basis, right? And if that's the case, for you to figure your monthly payment, you need to divide by 12. like you have right here. So the R that you should plug in into the equation in your Excel spreadsheet should follow this formula right here. It will be equal to your interest rate divided by 12. Simple, right? Because every month you're going to be paying less than 8%. It's going to be 8 divided by 12, right? So that you can pay 8% yearly. Okay, no surprise, but make sure that you don't forget this, because otherwise your numbers will not add up. Okay, and then finally, to finish our formula for the monthly payment, we need to compute N. Remember, N is the number of payments that you're going to make in the entire life of the loan. So in this case, because the maturity of the loan is 30 years, okay, what I'm going to have is 30 multiplied by how many payments I make in a year. I make 12 payments, right? So I'm going to have a total number of payments N of 360, which is 30 multiplied by 12. Okay, so if you multiply 30 by 12, that will yield an N of 360, which is equal to the total number of payments that you're going to make from the inception of the loan all the way to the moment where you get in the mail the title of your car or home, because the loan it's been already fully satisfied, right? Good. And if you do this, okay, in this equation, right, so you put P equal 100,000, R equal 0.08 divided by 12, right? And you put an N of 360, and you include that in all the terms where R and N show up. R shows up 3 times, twice in the numerator and once in the denominator, as you can see here. And if you do these calculations, you should get a number of 733.76. That will be your monthly payment. You're going to be paying this every month of those 360 months where you're going to be returning your loan. This is, of course, assuming that you don't make any extra payments for principal, which most banks will allow it, but I don't want to add that into the calculations because those are not scheduled at this point. Okay. Now, if you follow the conversation at the end of this presentation, you'll see how making any extra payments can easily be included into the calculations, and based on that, you'll get a slightly different table. But for that, we need to know what those extra payments are going to be made by the person returning the loan, and because we don't know, we're going to assume that there are none at this point. Okay. Good. Now, we have figured out the monthly payment. This is the starting point. Now what we're trying to do is we're trying to see how much of this monthly payment is going to go towards principal and how much of this monthly payment is going to go towards interest. And we know that this is going to be something that is going to change over the terms of the loan. So even though the monthly payment doesn't change, the other two figures do, and because of that we need formulas for them. Okay, so I'm going to walk you through the first couple of iterations of this process, and then what you're going to have to do in Excel is fill down. Okay, and the first step to figure how the monthly payment breaks down between interest and principal is going to be looking at the interest. Okay, I was going to say principal, but that's what we'll do later. Okay, so to figure out the principal, it's actually fairly easy, right? What we need to do for that is figure out how much are we paying in interest per month, right? And we know how to do that. We're going to call that, by the way, if you're curious, the monthly debt-in factor. If this sounds funky, this is a financing term. It's used all the time, but this is essentially your monthly effective interest rate, okay? And in our case, in our example, that is the yearly interest rate divided by 12, because we make 12 payments in a year. And that's going to yield for us this number right here, right? Okay, 0.00666666 until you get tired, right? Okay, this is how much I pay per month for the money that I own. Okay, now what I need to do is I figured out, given that I know my debt-in factor, and I also know that I haven't made any payments yet, so I own $100,000, which is what I started the loan with. All I need to do for the first month, but not for the rest, for the first month, is multiply what I own, which I haven't started paying anything, so it must be 100,000, times my effective monthly rate, okay, which is my debt in factor. So in this case 0.00666 in the example, and that's going to yield for me basically interest for that particular month, the first month of the loan, of $666.67. Okay. So remember, the monthly payment that we computed was $733, if I remember correctly, right? So out of those $730 plus dollars, $666 on the first month are interest. So it's mostly all interest, like we saw in the diagram that I showed you before. Okay. Now, what do I do once that I have this interest that I'm paying on the month? Easy. I'm just going to take my original monthly payment. And remember, this guy does not change in any month. It's always the same. My monthly payment or monthly debt service, okay, it's always the same. What does change is how is that spent between interest and principal. But once that I figured out my interest, which I just did, whatever is left from the monthly payment, it has to be principal. Okay, so what I do is I take the difference between these two terms, and I'm going to get my principal by default. This is the amount of principal that I'm returning on the first month, $67.09. So out of $733 that I'm paying, only 67 of those are going to be returning some of the money to the bank. The rest is just paying for the interest. Okay. Now, what I'm going to do after this is figure out how much debt I still have at the end of the first payment, because I'm paying some of that principal back. So I don't owe all $100,000 for the second month. I only own $100,000 minus that principal that I paid on the first month, which is $67.09. So at the starting of month 2, when I need to figure out my interest again, I don't start working with $100,000 anymore. Now I start with $99,933, right? Actually 32.92, not 91, right? You get the point. I'm just rounding up here, okay? But that's what you will, if, by the way, for being precise, don't round up, just point out in Excel to the previous cell. That way you don't have to, you don't make any rounding error, okay? Good. So if you've understood this, this is all essentially you need to do for the exercise. All you're going to have to do is now fill down in Excel. But I'm going to give you the next step just to make sure that you see how these things link together. Okay. So let's do month 2 and maybe month 3 as well, just to make sure everything is clear. Okay. So for month 2, what are we going to do? We're going to do essentially the same process. Right? We're going to compute the debt in factor. By the way, this one doesn't change either, like the monthly payment. So you only need to compute it once, okay? Have it once in the Excel spreadsheet and then point at it with a dollar sign to make sure that that cell becomes constant in your formula, okay? So your debt in factor, remember, is the effective monthly interest rate, or R, in your formula. And now what you're going to do is you're going to look at whatever was left over from the loan in the previous month, which in this case, because we are in month 2, it will be $99,933. Okay. And now you're going to multiply it by that debt in factor, which is going to yield for you how much interest you're going to be paying on the second month. And you see it's $666.22 in this case. Okay. And now, again, the monthly payment doesn't change. That's constant throughout the entire exercise. It's always the same. But the amount of interest decreases a teeny weensy bit. In the beginning, it goes slowly, the decrease. Over time, it gets bigger. Okay, so now you're going to pay in principal, the difference between your interest and your monthly payment, which in this case is going to be $67.57. Okay, so take the difference between these two quantities. Notice here the different sign. I don't know if you can see it with all the marks that I'm making in here. Okay, so I'm subtracting one from the other. Okay, and now again, I'm going to update my leftover loan, okay, or loan balance, by just subtracting from my previous loan balance my principal payment that I'm making on month 2. and this is going to give me what my balance is for month 3, which now is going to be $99,865, again with rounding. Okay, in Excel, don't round anything, just point to the previous cell, and that will carry over all the decimal places that Excel is capable of making calculations with. Okay. Now, just to help you out a little bit in how you need to lay out and set up your Excel spreadsheet, this is how your spreadsheet should look like essentially. You can make some changes to this if you want, but not dramatic. You're going to have your month, okay? And this is going to start, from month 1 when you own all the loan, all the way to the last month when you make all your payments. This is obviously for a 30-year mortgage. In the case of a car loan, which is what you're going to be working on for your exercise, you will have a much shorter amortization table because no sane company will loan you for a car a 30-year loan because cars depreciate fast, and at the end of their useful life they are worth pretty much zero, at least most cars, unless you're talking about a classic or something special. Anyway, we're not talking about special cases. So you'll have whatever term of the loan you have for your exercise, right? Remember, in months. Okay. Here you have your beginning balance, right? Beginning balance for that month, right? In the beginning, you start with the full amount that you borrowed, and then you chip away little by little, right? Then you have the monthly payment, which we computed following the formula that I provided for you guys. Make sure that you use that formula and not the formulas that are built in Excel. I know about those formulas already, but I want to make sure that you spend the time computing those things yourself. That way you make sure that you understand what goes into it, okay? You have your payment, and out of that payment, we've computed the interest. Remember, the way you compute the interest is you take your beginning balance, which in this case is 100,000, and you multiply it by your debt-in factor. Okay, so this quantity right here, it's this times the debt-in factor, which in my example is 8%. Okay, 8, so 0.089 divided by 12. Okay, so when you multiply 200,000 by this, you will get this quantity right here. Okay, and then we have the principal, which the principal is easily computed after you have the previous 2 columns, is the difference between the payment and the interest. When you subtract from 733, 666, you get $67, like you have right here. And now you're going to have your ending balance, which is going to be the difference between the column of the beginning balance and the principal that you pay. Okay. And now you carry over this into the next cell. Okay. You can do that in Excel by saying equal and pointing to this cell, and it will just do it for you. And then you can fill down, and it will point to the previous cell before. Okay. That's how you build it. Okay, and then you're going to go and do this again. Remember, the payment doesn't change. Okay, but you need to compute the payment not with a financial calculator, but with your own formulas. Okay, and then you'll get your interest, which will vary a little bit in the beginning and quite a bit towards the end. Okay, and then the principal, etc. And you just fill all this down. Once that you have it right, you've just filled down. And notice one thing, this is important for you to make sure that you did a good job and that it's correct. At the end of the loan, your ending balance should be 0. If it's not exactly 0, you made a mistake somewhere. Okay, this is a good check for you to make sure that you have it right. And of course, the number of terms in the loan needs to match the number of terms that you started with, right? So if it was a 5-year loan, this should be 60 terms, not 62.5, and because of that it matches, right? You get the point. Good. Also, you can see in this table, of course, there is a bunch of information missing in here because there should be 360 terms and we only have a few here. Okay, I think 8. And I just want you to see the drastic change in interest, right? In the beginning, we are paying more than 2/3 of the money in interest. Towards the end, we are almost paying no money in interest. And the reason why is because our ending balance for the loan is really low. So because of that, we do not pay a lot in interest. Okay, good. Okay, so what is your assignment then based on this? What do you need to do? To make it a little bit realistic, I'm going to ask you to do an amortization table for a used car. Okay, so to do that, what you need to do is search for an ad of a used car that you will realistically consider buying after graduation. So if it's $100,000, it's probably not realistic. Okay, just saying. So find an ad. You will have to include the link so that I can actually verify this. Okay. Then also find some financing rates for a car similar to the ones you're buying. You'll see that financial institutions usually have some restrictions on used cars. So for example, most financial institutions are not interested in financing cars that are more than 5 years old. Okay, but this is something you need to look into. Okay. Also, when you're young, you tend to pay more interest rate than when you're older. This is the way it is. It's a risk profile problem. Okay. So, do some inquiries about how somebody like you with, final degree already completed, with an undergrad degree completed, and, when you are in your early 20s, how much you will be paying for a used car. Used car loans also tend to be more expensive than new car loans, by the way. So look into that, and then also link for me or provide some references as where you got that information from. And then include a down payment. Okay, what is a reasonable down payment? Again, you can talk to your financial company, but in my experience, in the order of 20% is what they're going to be asking you. So if you need to go ballpark and you don't have more information, I'll say at least 20%. Okay, and then what you need to do is, based on that information from the ad, the bank, and or other credit institutions, and your down payment figure out your amortization table. How much will you be paying every month, and also where that monthly payments will be going, how much it will go to interest, how much it will go to principal, what will be the ending balance, and recirculate all that until you get to zero. Okay. Now, important things. Don't use a financial calculator and not put any formulas in Excel. That's not the point. Okay, I know there are financial calculators online that will do all this. I know that there are templates that you can get that do this in Excel. If I wanted to find those, I will do that myself. I want you to actually do the exercise to make sure you at least gain some understanding into how this works. Okay. Also, as a quality control measure, make sure that at the end of the term of the loan, your balance is actually zero. Okay, if it's not, that means you need to tweak it. And to change it, you made a mistake. In my experience in Excel, the biggest number of mistakes happen because of parentheses. Okay, Excel is a little tricky with this, even in the color coded parentheses. So be careful. It is always better to put more parentheses than less parentheses, so long as, of course, they make mathematical sense. Okay, I'm assuming you know how parentheses work. Just saying. Okay. And then finally, make sure that you include the references to your research in the file. And that's it. For due dates, look at Canvas.